This is Under the Lens, featuring economic research by Gordon T. Long, editor and publisher of GordonTLong.com. The content of this presentation is strictly the opinion of Gordon T. Long and is based on facts he feels to be accurate as a result of his research at this time. All listeners are advised to independently verify all research for market changes. The following opinions are not in any way a solicitation for business, nor should they be considered investment advice. You should always consult a registered investment advisor before making investment decisions. Now, let's join Gordon for today's show.
Good morning. It is Monday, February the 24th, 2014. I'm Gord Long at GordonTLong.com. As is normally the case, I have a lot of charts for us to go through this morning, so therefore I will pass over some of them quickly, but leave you to examine them further at your leisure. You'll need to open your viewer to full screen viewing or you'll not be able to see some of the detail I'll be discussing. A reminder before we begin, do not trade from any of these slides. They are for educational and discussion purposes only. The purpose of the audio is to discuss key developments in those areas not specifically updated in this month's Global Macro Tipping Points Research Report document. The research document this month updates global risk and tipping points. Therefore, the slides this morning will focus on our other three report areas of the Global Macro Tipping Points Report, the macro, regional, and U.S. economic developments. As I often do, I'd like to tie them together in a discussion of what has been occurring since the beginning of the year that has been affecting the financial markets. I want to focus on what I'll refer to as the TAPER TANTRUM 10. This group of 10 countries consists of what is often referred to as the Fragile Five and to a lesser extent the Forgotten Five, and I'll list those and show those in a few slides. We're seeing a frightening rate of global slowing across the world, and it's becoming evident even to the mainstream media. In the U.S., the Fed taper is looking down the gun barrel of a potential U.S. recession, and my work with Richard Duncan suggests if quantitative easing is not increased by about $500 billion to $1 trillion going into the second half of the year, then the recession is a very strong possibility. I'll actually indicate a little later where I think that money is going to come from. The European version of the quantitative easing is being set up to address part of this problem. China, in my mind, managing the debt buildup of the shadow banking is becoming almost impossible for them. Abenomics in Japan is blatantly failing. There's no question about that. I also want to talk about changes in foreign direct investment and specifically how liquidity and credit, though liquidity and credit is growing, the FDI, foreign direct investment, is missing. Then I'd like to wrap it with a discussion on the G20 meeting, which just culminated in Sydney, Australia, and what the real message was there that was hidden, but not for those paying particular attention. Global economics is not as complicated as the Ivy-trained Keynesian economists would have you believe. As Goldman Sachs gleefully illustrate, the world could presently be considered as divided into two financial warring camps. One, the emerging markets, labeled here as EM in light blue, who have inflation problems. And two, the developed markets labeled DM in dark blue that have a disinflation to a deflation problem. It actually is not an emerging markets problem, but rather a peripheral nations problem. The peripheral nations are those nations who are not yet fully industrial nations, but rather still resource nations. Industrial nations consume resources, and hence resource nations are very dependent on the economies of the industrial economies and are desperately themselves trying to get there because it historically has meant higher levels of employment, which is a big problem in resource nations, higher value-add product pricing, and economic stability versus the roller coaster of being part of the commodity cycle. The Fragile Five consists of three elements of the BRICS: Brazil, India, and South Africa, and the other two being Indonesia and Turkey. They're the ones that get most of the press, and certainly from a current account issue deserve that. But to a lesser degree, discussed is the Forgotten Five, as I mentioned earlier, and they are Venezuela, Argentina, Malaysia, Philippines, and Mexico. And the first two have serious social unrest on the go right now. All 10 of these are suffering inflation issues, and these inflation issues are coming from the developed countries by effectively exporting their inflation. They're printing the money, they're expanding the money supply, and that money has been heading in big ways as hot money into these countries. Yes, it's pushed up growth, but it's causing all sorts of problems. The Forgotten Five are more visible here when we look at the current account balance as a percentage of GDP versus net international investment positions as a percent of GDP. And you can see there are other countries, especially in Central and Eastern Europe, referred to as CEE, which are also potential storms of brewing, and may not individually be major catalysts, but as a group have a dominant impact on European banking, who have been lending excessively, in my mind, to these groups of countries for the last 15 years. The emerging markets have become the economy. Something has quietly been happening over the last decade other than continuous financial turmoil and bubble economies. The willingness of the emerging markets, that is, the peripheral nations, to accept the currency that is being endlessly printed to finance economies that basically consume more than they produce, has allowed an overexpansion and overreach by these emerging markets trying to become industrial nations. And you can see here in the second chart that the BRICS are 43% of the global growth, and all of these five in the BRICS have got serious issues. Tells you the fragility of the global economy. As a consequence, today we are left with output gaps in the developed markets and current account payment deficits in the peripheral nations. All of this has placed the world on a destructive path towards what can best be termed a globalization trap and eventually a global fiat currency crisis. The roadmap is easy to discern and quite evident if you actually study the signposts without wearing Keynesian filtering glasses and apply a dose of just common sense. The globalization trap is spelled out in this year's thesis paper, so there's no need to go into it further here, and I'll leave it to you to review the document separately. The roadmap has profound implications for the financial markets as economies of both the developed and emerging markets move through an almost preordained cycle shown and labeled in this chart here. Goldman Sachs Global Leading Indicator, the GLI, January reading and the latest revisions to previous months paint a significant softer picture of global growth, placing the global industrial cycle clearly in the slowdown phase. Goldman points out rather ominously, and I quote, "While the initial shift in the slowdown had a fairly idiosyncratic flavor, the recent growth deceleration now looks more serious than in previous months. The January final GLI places the global industrial cycle clearly in the slowdown phase with positive but decreasing momentum." Can't be any clearer than that. Just think of all of this cascading together, and it only takes one weak link in a fragile, overextended state to really cause significant contagion effects, especially with collateral rehypothecated so many times now that, frankly, the governments can't afford anybody to bankrupt or anybody to fail. And therein lies the problem. The last 3 weeks have seen the macro fundamentals of the G20 major economies collapse at the fastest pace in almost 4 years and almost the biggest slump since Lehman. Despite a plethora of data showing that weather is not to blame, U.S. strategists, economists, and asset gatherers are sticking to the meme that this is all because of the cold on the east coast of the United States, and that means wondrous pent-up demand to come. However, as the New York Times reports for the Earth, it was the fourth warmest January on record, and we're looking at G10 and global numbers here. Since the November data, the economic surprise indices for both Citigroup and Bloomberg have been absolutely plummeting. Something happened going into November, December. It might not be surprising for you to learn that the U.S. is a top destination for foreign direct investment, or what I'll refer to as FDI. According to new United Nations data cited by U.S. Trust Joseph Quinlan, the U.S. accounted for $159 billion of inflows of the global total of $1.46 trillion of flows in 2013. This is down. This is down from $168 billion in 2012. That's $1.46 billion. This must grow, not go negative. It is not about the absolute amount, but rather the rate of change and whether it is positive or negative in the absolute. Let me put this into perspective. If you're traveling at 100 miles per hour and you abruptly hit the car brakes as a passenger, it can cause serious consequences. If the car is then suddenly slammed into a reverse direction, a fatality may often be the likely outcome. Similarly with FDI, or foreign direct investment, not only dramatically slowing but also being slammed into a negative direction, we might expect major consequences. However, true to form, our Keynesian government economists and the compliant media report this by saying it's a short-term anomaly. Tell this to the passengers. The best way of describing this is from Apollo 11. Houston, we have a problem. We have dramatically slowing U.S. foreign flows. This chart shows holdings of the Chinese treasuries in a nutshell. China's treasury holdings plunged by the most in 2 years after China offloaded some $48 billion in paper, bringing its total to only $1,269 billion, down from $1,317 billion, and back to the level last seen in March 2013. This was the second largest dump by China in history, with the sole exception of December 2011. That this happened at a time when Chinese foreign exchange reserves soared to all-time highs, and not investing in U.S. paper should be quite troubling to anyone who follows the nuanced game theory between the U.S. and its largest external creditor, and the signals China sends to the world when it comes to its confidence in the United States. Yet what was truly surprising is that despite the plunge in Chinese holdings, and Japanese holdings also dropped by $4 billion in December, is that total foreign holdings of U.S. Treasuries increased in December from $5,716 billion to $5,794 billion. Why? Because of this country. Guess which one it is without looking at the legend? Belgium. That's right. At a time when America's two largest creditors went on a buyer's strike, the entity that came to the U.S. rescue was Belgium, which, as most know, is simply another name for Europe, the EU, the ECB, the continent that has just a modest amount of its own excess debt to worry about. One wonders what favors were and are being exchanged behind the scenes in order to preserve the semblance that all is well. For whatever reason, China sold the second biggest amount of U.S. Treasuries in December. However, that was only part of the story. In fact, while the two largest U.S. foreign creditors were net sellers, total foreign bond holdings actually rose in the last month of 2013. And as the chart here shows, when it comes to long-term treasury paper, foreigners were actually buyers of some $18 billion in treasuries. It is everything else that they sold in the month when the S&P hit its all-time high. Specifically, foreigners were net sellers of agency securities, $15.4 billion, corporate bonds, $7.5 billion, and corporate equities, $13.7 billion. Something which hardly fits with the narrative of the record stock market high generating confidence and even more buying down the road. In the chart here, the black line, which is gross purchases of U.S. long-term securities, is most troubling, as its trend is hardly anyone's friend. It can't be any clearer. This is not a short-term issue. It's just part of a longer-term secular trend line. So what happens when one smooths out the line to normalize for monthly fluctuations? This is what you get. The chart is very disturbing because it shows that as the S&P rises higher and higher on ever-declining volumes, foreigners are buying fewer and fewer U.S. securities. In fact, on a 12-month moving average basis, foreigners bought less long-term U.S. securities than they did when Lehman crashed. Luckily, we live in a new normal when price is no longer determined by simple supply and demand, and certainly not from retail investors who have long since given up on the fraudulent, broken U.S. capital markets, but Fed job owning of a record $2.5 trillion in bank excess reserves, 2 corporate buybacks, and 3 high-frequency trading algos spurring momentum ignition and buying because others are buying. And so we have come full circle, because while understandably nobody had any appetite for U.S. securities around the Lehman crash until the Fed stepped in and single-handedly took over the U.S. capital markets, it was unclear if there even would be a U.S. capital market. Now, 5 years later, the S&P has risen to a level nearly 3 times the March 2009 lows, thanks entirely to the Fed's $4.1 trillion balance sheet backstop. The interest in U.S. securities is lower than it was in the days just after Lehman. So what is the world's leaders' view on all this? What are they going to do about it? Let's have a look at the just completed G20 summit meeting in Sydney, Australia. Quote, "We will develop ambitious but realistic policies with the aim to lift our collective GDP by more than 2% above the trajectory implied by current policies over the coming 5 years. We want to add over $2 trillion more in economic activity and tens of millions of new jobs." Interesting number, $2 trillion. Where is it coming from and who's delivering it? There is only one problem. The G20 has absolutely no idea how to actually achieve its goal of boosting global output by more than the world's 8th largest economy, Russia, produces in a year, nor does it have any measure to prod and punish any laggards from this most grand of central planning schemes. There was no roadmap on how nations intend to get there or repercussions if they never arrive. I think there's a lot more going on than this shenanigans of wording here. And not that I think they've got a grand plan, but they're going to resort to the only plan they know how to do, and that's money printing. And separately, but in parallel, Mario Draghi was highly visible in a press conference at the G20. And the European Central Bank President, Mario Draghi, signaled at the G20 meeting that the ECB's March 7th policy meeting could be critical in determining whether the ECB will provide additional stimulus to shore up the Eurozone economic recovery. And I quote, "By then we will have the full set of information needed for us to decide whether to act or not," the central bank chief said. Mr. Draghi's comments, highlighting the significance of the meeting, are intended to boost market speculation that the ECB will cut rates at its next policy meeting in early March. But I believe it's much more than that. Inflation growth in the Eurozone has been well below the central bank's target for months, prompting fears of deflation, defined as a persistent downward trend in prices that threatens consumer spending, wages, business profits, and investment. At the March meeting, the Eurozone Central Bank will release its 2016 inflation forecast, the first time it will issue projections with such long time horizons. The ECB held all its key interest rates steady when it met this month, despite annual Eurozone inflation at a low 0.7%, well below the ECB's mandate to maintain price stability, defined as inflation just under 2% over the medium term. But analysts expect the central bank may have sufficient grounds to lower interest rates or take other stimulus measures if the ECB's own staff inflation forecast remains significantly below the target. Here's what's really going on. The ECB is getting set to launch its version of quantitative easing. I've been posting a steady stream of information that indicates that this is very close. Most recently, the German Bundesbank formally capitulated publicly by agreeing to the removal of the sterilization requirements by the ECB. This is the green light and tells us how serious even Germany now sees the global problem. In the game of ring around the rosy by the currency cartel, it is simply the ECB's turn to print, and print they will. An 8% market correction, and the world will demand it. My time frame personally is the spring following probably shocking Q1 earnings season surprises. In closing, I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. As negative as the comments are, there has seldom been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed professional financial advisor. So until we talk again, may 2014 turn out to be an outstanding investment year for you.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.